is determined in the international market and by the supply and demand. Now, here I would like to show you the risk of regulation that has been imposed to the LIBOR, for example. This is an example. I would like to say that even in a regulated market and mature market, we do have such a risk. We had this credit crunch in year 2008, and then we saw a lot of media reports on the rate manipulation, the LIBOR rate manipulation. Some banks, the report were saying that some banks tried to offer some lower rate to benefit from their other activities in the international financial market. So it happened in September 2008. In March 2011, some banks actually informed and announced that regulators are trying to investigate them. There has been something suspicious. June 2012, as a matter of fact, Barclays, which is Barclays Bank, which is a very famous bank, was fined $450 million because of this manipulation. So they accepted that they have manipulated the rate, and they benefited a lot from this rate manipulation. In September 2012, the UK government proposed reform on LIBOR. They said this is not acceptable anymore. This is a very important rate. We cannot tolerate this manipulation anymore. Then in July 2013, the regulator decided to give the calculation and everything to a company called Euronext. The amount of this deal was only $1 to punish the British Bankers Association for their fault on manipulation. So let me conclude on this slide that black swan does exist. Risk and uncertainty, even in the regulated market, there is a lot of risk in even regulated markets. So we should be very careful when we are talking even about fixed income assets. So sovereign wealth funds are trying to allocate a big portion of their capital on fixed income. And they are trying to buy and allocate their money on the AAA rating, credit rating classes, because they would like to have lower risk, and the risk tolerance is not that high. I would like to give you some example on GPFG of Norway, which is the biggest ever fund in the world, and the GIC of Singapore, how they manage their asset under management. So this is like, I think this 5 or 6 funds have more than $4 trillion asset under management. If you look at the pie chart here, this light blue shows the share of fixed income assets. For example, the bond. You can see that all of them have a considerable share in fixed income. For example, Future Fund of Australia, GIC of Singapore, or CIC of China, and ADI of United Arab Emirates, and GPFG of Norway. You can see that like 40%, 30%, a big share is allocated to the fixed income asset classes. If we look at GIC, for example, there are 3 types of policy that they have taken. For example, if they took conservative portfolio for their investment, like 30% in equities, 40% in bonds, and 30% in cash, during the last 20 years, they could have a return of 5.8% annually. And if they have chosen, for example, the classic portfolio, where 65% equities and 35% fixed income, the rate would have been 7.2% annually, the return. While they materialized, the actual portfolio that they do have is 60% equities and 40% bonds and fixed incomes. So they have the annual return of 6.5%. So a big portion of this portfolio is fixed income, as you can see from here. And this is the GIC, our Singapore policy portfolio. You can see that the inflation-linked bonds, it could be between 4 to 6%, and nominal bonds and cash could be 25 to 30% in the total portfolio. They have actually 9 to 30%. They're eligible to buy real estate, and the rest could be different type of equity. But you can see that here a big portion of the portfolio includes fixed income assets. Now, I return here to the GPFG of Norway, the largest ever fund in the world, and this is the chronology of the portfolio policy, as you can see here. In 1996, they received first inflow of capital in their fund. In 1998, they decided to have 40% share in equities. In year 2002, they were allowed to have non-government guaranteed bonds, which is a kind of fixed income asset. But in year 2007, the red column here, the red bar here, they actually changed the risk portfolio. They increased their risk tolerance. So they decided to have 60% share of equity from stock markets. And they were unfortunate because the next year, actually, we had this credit crunch that they lost almost 35% of the value of their fund. Although the years after they could revive a portion of that, but they lost a lot. So in year 2008, it happened like this, and they decided also to have 5% eligibility to buy real estate. If you look at current portfolio policy, you can see that they are actually allocating 6% of the whole capital in equities, 35 to 40% in fixed income and bonds, and 0 to 5% in real estate. The column beside actually shows what it actually happened. Right now, 62% equity, 36% bonds, and less than 1% real estate they have allocated. This is actually their portfolio. Now, if you look at these two pie charts, you can realize what is their policy on fixed income. The type of fixed income they have chosen is most government related. The government bonds is more than 60%, the green actually part of the pie, and 11% somehow government related bonds. Altogether, more than 70% of the fixed income asset they have bought is government related to have lower risk. Now, there is another characteristic for this policy, which is buying fixed income that have higher rate of credit rating. You can see here from the blue part that more than 50% of the asset they have bought has got AAA credit rating, and of course more than 80% is in the category of A rating. So they're trying to actually be in the safe side and not to have a lot of risk when they are buying fixed incomes. And this is the result of their policy, portfolio policy. You can see that last 12 months, 30% was their annual return. If you look at the long-term return that they had, the annual return is 5.0%, is almost 5%. So their annual return on their policy portfolio and what they have done is only 5%. Now, let me just briefly discuss our portfolio policy at NDFI. As it was mentioned this morning, 90% of our capital will be, based on the current roadmap, will be used for domestic financial activities. And 10% has been decided to invest in international financial market. This 10% and 90% is not a fixed percentage. So every year we do the analysis and we optimize this 10% and 90%. It could change every year. What we are looking at is the risks from domestic and international market as well. So there are a lot of risks on country risk, bank risk that we have a lot, and project risk. And besides, there is an issue of overheating. We should be careful not to inject a lot of dollar and a lot of money to the economy, because we should be careful about economy overheating, and we should look at the capacity that the economy can absorb the money. So based on those elements, we decide how much should go to the domestic and how much should go to the international. For the international financial market, our policy is low risk securities, and we have a passive strategy like a buy and hold strategy. We buy bonds with low risk and we hold them, but the approach is laddering approach, as such that we buy gradually and we are not actively in the market do the selling and buying. So it's like a laddering strategy. And of course, because our low risk policy that we have accepted, we will buy in the category of AAA or like in the category of A rating. Now, at the first step, our policy is that to do our own analysis. So we form the portfolio in international market by ourselves. So we buy fixed income assets in the rated phase in the group A, and it will be a passive approach, and as I mentioned, a laddering mechanism. But in the second step, maybe in 1 or 2 years' time, we will allocate a portion of our assets in the hand of asset manager, and we try to optimize based on the index portfolio. And also we are trying to buy these fixed income assets based on the hard currencies like which are presented in the SDR currencies like US dollar, euro, yen, and pound. And we are not the policy, we don't have the policy of buying assets, fixed income assets in domestic currencies. And that's the reason, if you look at the exchange rate between SDR and US dollar, you can see that there isn't much turbulences in the exchange rate of SDR and with compared to, of course, US dollar and other currencies. So that's our policy for the time being. Of course, we do a lot of study and we might amend this policy, but this is what we are doing right now. And thank you very much for your kind consideration.